Good morning, ladies and gentlemen. We have the next 12 minutes for me to share with you what's happened in SA equities in the last 12 months. And I'm going to do it in three parts. Part one, I'm going to look at what happened in the markets in the last 12 months, what happened in the market in the last 36 months, and what are some of the themes that we've seen play out. Second thing, we're going to look at our smart beta funds and our market cap weighted index funds. And very importantly, how have they performed? And finally, I'm going to have a look at the very, very important topic on ESG and how we think about ESG in our passive and smart beta funds. So if we look at the asset class returns in the last 12 months, what I'm showing on this graph, if you look at the far left in the dark blue charts, is how has the SA equity market fared and how have the various sectors within that fared. And you can see SA equities up around 40% for the last 12 months. And all the sectors up really nicely, and SA listed property up around 65% for the last 12 months. Not surprisingly though, given that it had some real challenges in the year before. In the fixed income space, you can see bonds up quite nicely, and cash. Had your money been in cash in the last 12 months, you've earned less than 4% on your funds. Precious metals not doing too badly, and oil up 120% in the last 12 months. And on the far right hand side, I'm showing, had you been invested in some of our offshore markets, how has your funds performed? And you can see it doesn't really matter where you were invested. You've had strong returns if your money's been offshore. And really talking to that theme of you need to be well diversified locally, but you also need to be well diversified by having assets sitting in the various offshore markets. And interestingly is that the Rand is actually 10% stronger than where we were 12 months ago. If you look over a 3-year period, you get some of those themes now playing out. You can see SA equities up around 9% per annum for the last 3 years, financials flat. So if you had all of your money invested in our financial stocks, you've earned 0 in the last 3 years. Not surprising though, because with COVID, banks, insurance companies, medical schemes really got decimated. If you roll forward and you look in the precious metal space, gold up around 13.5% per annum for the last 3 years, actually doing better than if you were invested in our own stock market. And gold has a wonderful habit of being a great hedge against inflation in the medium to longer term. And the best example of that, if you look over the last 50 years and you compare the US dollar to gold, and we probably think the US dollar is a very strong currency, probably very strong to most of what we get to see, gold has actually appreciated by 98% compared to the US dollar. Or put differently, the US dollar has lost 98% of its value compared to gold. A great example of inflation. And from a sort of global perspective, you can see that our various foreign asset classes all performing very strongly for the last 36 months, and the Rand actually only around 2% per annum weaker over the last 3 years. This is a graph we really do pay close attention to, and it helps us understand whether active equity managers in South Africa are able to consistently add value relative to the benchmark or relative to just buying a capped SWIX or a sort of index fund. And what the graph shows is if the line is above the x-axis, and as you can see on the far right-hand side of the graph, those bars are higher than the x-axis, and that's showing us that in the last 12 months, active equity managers are able to outperform the market, able to add alpha or add value to our clients. And that's certainly not surprising. Sort of, if one considers that during the extreme market turmoil we've seen in the last 12 months, one really would hope this is the time for active managers to come to the front. And that certainly is what's been happening. But what it also shows you that there are significant periods in time where active managers struggle to outperform the market consistently or struggle to actually add alpha for their clients. And I often get asked, Wayne, why would you buy a capped SWIX index fund, such as the Momentum capped SWIX index fund? If net of fees, I'm guaranteed to underperform the market slightly. And yes, the statement's true, but the fees are tiny, right? So you're only going to underperform the market slightly. And if you look at this graph, it shows you that underperforming the market slightly is going to do a lot better than active management during some of our market cycles. So a capped SWIX index fund certainly has its space in anyone's portfolio. We look at the same graph for SA listed property, and in this asset class, it shows that Here, active management seems to consistently add value for clients, where in the listed property space, we're able to consistently add alpha by investing in a more active way as opposed to buying the underlying index funds. It's important that we have a look at again, what is the difference between a market cap weighted or a normal index fund and a smart beta fund? So your market cap weighted, or your, as a prime example, the Momentum CapSwix Index Fund is your classic buy the market fund. So you've bought the market and I've got exposure to every share in the market. And if you look in the last 12 months, the best SA equity fund in our market had a return of 72%. The worst equity fund had a return of 3%. That's nearly a 70% difference between the worst and the best fund in the last 12 months. A lot of buyer's remorse if I happen to choose the wrong asset manager. And that's where your index fund really comes romping in. You've bought the market, there's no chance that I've chosen the wrong manager for the last 12 months. And your smart beta funds, they have the ability to actually add alpha, to outperform the market by capturing a particular style. Styles such as value, momentum, and quality. They look active in terms of how they behave, and I'm going to show you graphs that you'll be convinced this must be an active manager, but they're systematic, passive funds in terms of how they actually behave. So really, if you look at it in a simple graph, your active management is where most clients would actually look to go as a first point of call, but they generally have higher fees in that particular space. Your passive funds, or your sort of CapSwix index fund as an example, is your buy the market. Fees are significantly lower, but you're not able to outperform the market. You're buying the market. And your smart beta funds typically play somewhere in the middle. They're not passive because they have the ability to outperform the market, but they're not active in terms of how they behave either. There's not a portfolio manager making active stock calls deciding to go overweight this share or underweight that share. It's more of a rules-based or a systematic process in terms of how it behaves. So when we think about SA equities and what do we want to put into our portfolios, we're adamant that we want to see various styles. We want to see styles such as value, styles such as momentum, or as we call it, trending, and a style such as quality. Those are the three primary styles we want to see in any SA equity fund. And from our perspective, those three styles give you sufficient diversification into your SA equity building block. At Momentum, we have the smart beta funds of value, of trending or momentum. And we've just launched our quality unit trust into the unit trust platform in the last couple of months. And our value and our trending fund, as I'm going to show you, now have a 4.5-year track record. Wonderful portfolios for clients to consider. If we look at our trending fund, our trending smart beta fund, how has it performed since it launched now 4.5 years ago? And in a single word, wow. It really has done exceptionally well. What this graph shows in red is how the fund has performed over the last 4.5 years, and in blue how the CapSwix index has performed, or how the market opportunity has performed. And you can see the fund has significantly outperformed the market over its 4.5-year time frame. And anyone looking at this graph would be more than fine to have made the wrong assumption that this has to be active management, and this active manager clearly knows what they're doing. It's a smart beta fund, and yet it's managed to significantly outperform the market. On the value fund, it's the same story. Also in its 4.5-year track record, significant outperformance to the market opportunity, but not performing at the same time as what the market trending portfolio has been doing. Fantastic result for clients, and the net result, while similar at the end of 4.5 years, have got there in two very different ways. And that's exactly what we want to put into our client portfolios. Diversification to get a better and smoother result for our clients. So bringing it all together, how do we think about it? Well, if you invest in one style only, you're in for a very bumpy ride. It's going to be a roller coaster ride through highs and lows, and you're going to do well to hang on to that fund through a medium to longer term period. There's going to be times if you're in one style, you're going to start questioning yourself, should I be getting out? Should I be choosing something else? And those kind of decisions made at those points in time are often not your best decisions. So you want to blend in styles. You want a CapSwix fund, you want exposure to value, you want exposure to trending or momentum, and you want exposure to quality. That's going to give you a blended SA equity solution that gives you a much better result through time. I've said it before and I'm going to say it again, don't ever try and time your entry and exit from these styles. The best strategy in the long term is have exposure to the styles and let those styles run through the medium to longer term. don't make a call that I should now be going overweight value, or now is a great time to go overweight quality. 9 times out of 10, that's going to be a losing strategy to implement. And of course, with our smart beta funds, you now have the ability to actually diversify your exposure even further, but by introducing smart beta or more passive strategies, as opposed to only having to look into various active alternatives. We also have the Momentum Core Equity Unit Trust, which is exactly what I've now just put together for you. This is also a unit trust that has a 4-year track record now, and is exactly that. It's a blend of a capped SWIX index fund, the value, the momentum or our sort of trending risk premium, and our quality strategy. It's a blend of those 4 things into one fund, and look how amazing it has performed since it was launched, significantly outperforming the market and doing incredibly well compared to its peers. And yet it's not an actively managed fund. It's an extremely well diversified fund, but it's a blend of an index fund and 3 smart beta funds. And the final topic is around ESG. And this is such a hot topic at the moment. I literally can't go to any client feedback session or to any client meeting where we don't end up talking about ESG. How is Momentum incorporating ESG into how you run your index funds and your smart beta funds? How are you addressing environmental matters, social matters, and governance matters into your portfolio construction process and how you run your funds? And at Momentum, it's completely integrated into how we run our client portfolios. It's part of our DNA, it's part of our process, it's part of our philosophy. And we tackle ESG on all 3 pillars, from the environmental side, from the social side, and from the very important governance side. And our clients take tremendous comfort that we do our utmost to be responsible investors with client money, and we really are operating at the very market leading edge of how to incorporate ESG into our portfolios. From a global perspective, we're seeing some pretty innovative things happen. We're seeing new indices being constructed that take the universe of shares and then strip shares out based on how they score on these 3 metrics. It's a great theory. I'm not that sure it plays out well in our markets yet, because we don't have enough shares to start stripping out a whole bunch of shares. We're going to be tracking some pretty interesting market benchmarks if we take that view. But from a client perspective, you can be very happy that we are at the front edge of this. It's very topical in all of our client conversations, and we're very aware of how it plays into how we run client money. Thank you.